All right, let's start up. All right, so I'm making this argument: pension plans should look a lot more like life insurance companies when it comes to what they invest in, mainly corporates, longer term bonds, but they don't and they haven't. So why is that? I've got a few theories. So my first thing is accounting. The accounting for pension plans, and I had to learn this, just so bizarre accounting, but essentially what they would do is if there were large losses in the stock market, you would take that and you would allocate it over the next 30, 40 years. So a 20% drop looked like a 0.5% drop. You'd hardly even notice it. In fact, there were even years where firms had huge losses on their portfolio and they were showing pension income. It was just the most bizarre thing. And the FASB decided to change pension accounting, realizing that this could be pretty political. There's a few firms, like in the auto industry and a lot of manufacturing, that pension plans are huge parts of their liabilities. But they essentially moved to fair value accounting. So if your stock portfolio loses $300 million, $300 million loss goes through net income. Pretty intense. Well, that makes firms really nervous. That's a lot of volatility. Like, that's going to make our plan look really volatile. And my argument was, no, it's going to make it look like it always has been. Before, it made it look like it wasn't, and it really is truly that volatile. And so a lot of corporate plans said, that's it, we're out of the pension plan, we're shutting these down. That's when USAA got out of its plan. The other thing is, stock market did so well in the 80s and 90s, and that's when most people were setting these plans up and were really funding these plans. And it was like a free employment benefit. They weren't having to fund their pension plan because the stock market was up so much. It was just paying for itself. Pretty amazing. And so this argument people would make, this is the argument the guy from AT&T made, is, hey, we've made all this money in the stock market, so obviously it was a good strategy. That analysis ignores the whole concept of risk. If you believe this argument, you should put all your money in Apple stock right now, 100% of it, because it's worked really well in the past. The argument that something's worked really well in the past is not an argument for why it should work well in the future. So, you don't make investments based on historical returns. See, some people say, well, the stock market always outperforms bonds in long term. Is that even true? It's somewhat true in the US, although if you adjust for inflation, there was a pretty good 20, 30-year period where stocks really did not do well at all in the US. But the other thing you always have to remember is the US is somewhat the exception. Most stock markets in the world have had horrendous periods of time. Japan is still down dramatically from where it was back in the 80s, still down, more than 50% down more where it was back 40 years ago. So it's not, it's been 40 years and it's still not even close to being back. So the US is somewhat unique. Now, will US continue to be unique going forward, or is it possible the US stock market's going to have a major crash? Who knows? But we don't know the answer to that. We do know it's worked well in the past. If you know it's going to work that well in the futures, I always think, if you know stock's going to make 10% going forward, do you care what standard deviation is? You really don't care, do you? You're just like, hey, if I'm going to make 10%, I'll make 10%. Why not? I don't care about the bounces. But we don't know that. What if the US stock market does what the Japanese stock market does and sells off 80% and never recovers fully on the way back up? So that's certainly possible as well. But the argument that it's worked well is just not a good risk argument, because you can always find something that's worked well the last 20 years. And I think that's what people would tell me, because the strategy we moved to worked extremely well in 2008. But then people are going to say, yeah, but look what you've missed out on since then. But no one's saying that to life insurance companies. Certainly life insurance companies, they could have gone to stocks these last 20 years and they would have benefited from it. So the question is, what's the right risk adjusted return? And pension plans have been destroyed, even though the stock market has done decently. Interest rates have come down so much that pension plans have just been a disaster for corporations. So most firms have discontinued their pension plans. You can see it, it's in the numbers. I think I could probably find defined contribution versus defined benefit. And you can find charts. I don't know if Investopedia has one, but you can find charts that will show you the large increase in 401k plans. Unless I have a class looking at me, then I can't find it. It looks like an interesting article there, but you'll see it. 401k plans are just shooting up. Pension plans are just going close to zero. The only places they still exist are in heavily unionized places that the workers are just not allowing them to be shut down. And you know, state plans and government type organizations, they still have pension benefit plans, defined benefit plans. So they saw interest rates falling, making their liabilities drop. The accounting rules changed, making their plans much more volatile. Had a horrible bear market in 2000, horrible bear market in 2008. Just a disaster. Like I said, every single. So I had this. I wish I had the magazine, but 1,000 largest pension plans, 999 of them all went from a surplus to a deficit in 2008. They all lost 100% of their value and then went negative. It was a pretty disastrous time period. Oh, there's a chart. This one's out of date, but defined benefit, defined contributions. Most of y'all will see defined contributions. We'll talk about that. So some of y'all are thinking, well, are you telling me to put my 401k in the bonds? And if you took my life insurance class last semester, Joshua can probably explain that one. It's a little different because of human capital, which I'll let Joshua, you can do that part of the lecture. I'll let you take that over. But so we have something different that corporations don't have, which is called human capital, which is a very different asset that what corporations have. That changes how we allocate. It allows us to buy a lot of stock. But we're talking here a pension plan, which is a very different thing. Public pension plans are still being offered, and they're putting states insolvent. They're destroying these states. These plans have high allocation to the U.S. stock market. Why? Mainly because they have no choice. They're so underfunded, they have to make 8, 9, 10% returns or they're done for. So this is the kind of Vegas doesn't look really bad. If you owe $400 million, Vegas doesn't look like such a bad strategy. You know, if you owe $4,000, then yeah, don't go to Vegas, you know, work it out. But if you owe so much money you can't possibly pay it back, then yeah, take all your money, go to Vegas. Worst case is you're bankrupt anyway. Best case, you can make it. And the accounting rules for state plans have not changed. They continue to have these really bad accounting rules that allow them to really understate the risk. Several states, like Illinois, are essentially insolvent, and they really can't fund these plans. You can go look at these. I haven't looked at this site since I set this up this summer, so let's see if it's still around. Sometimes these sites disappear. Yeah, look at that. February 28th. Oh, yeah, it doesn't exist anymore. Sorry. Well, when it did exist, California, their pension plans, their deficit was $75,000 per California household, underfunded. California underfunded is almost $1 trillion. This $1 trillion depends on how you do it, because we talked last class. Do you use expected return on assets? Do you use corporate yields? Do you use treasury yields? What discount rate do you use? That $1 trillion moves around dramatically depending on what discount rate you use. I mean, it's because remember, this is very long duration. Whether you use 7%, 5%, or 4%, you get massively different numbers. So it's somewhat scary. So I personally, and this is where I'm a little paternalistic, I do like defined benefit plans for employees. I think it's an excellent retirement tool. Mainly, I'm just that friend I had, her 401k plan was like $50,000 or something, and she needed to retire. You're not going to retire on that kind of money, but her USA pension plan was worth a few $100,000 that she could retire on. And she had no control. There's nothing she could do to impact that. She could devastate her 401k plan pretty easily. And what we're seeing right now is it's very, very barbelled. The poorest Americans are the ones rating their 401k plans the most. And a lot of them, they just like this particular lady I was working with, she had a son who had a lot of problems, and she was bailing him out of trouble, and that's where she had the money. So she was taking out of the 401k plan. It's not, I'm not saying, wow, this undisciplined person, buying jet skis. That's not what she wasn't buying jet skis. She was, family emergency kind of things. And this is where she could go to get the money. And yeah, these plans are not building up for the majority of people. Most people, it's going to be a very underfunded 401k plan and Social Security, and that's what they're going to have to live off of. And how many of your parents can live off of Social Security? Like I said, with my mom, hers is $2,000 a month, and her assisted living is $6,000 a month. Fortunately, she had a house in Austin. That's her pension plan. Is her house in Austin. She didn't buy it for $100,000 and sell it for $500,000, planning that. She just got really lucky that she was in Austin where she sold this house. That house was not worth what she sold it. I can tell you that. It was worth much, much less than that. It was a horrible house with a lot of problems. And I was perfectly honest with the guys. Yeah, there's all kinds of problems with this house. Okay, well, $540,000. Okay. Like, it's not worth it, but okay, fine. You want to pay me that much money, that's fine. But that's not a good retirement plan. I mean, she's very fortunate that she has that, and her sons are going to take care of her, but she's probably in the top 1% of having absolutely nothing to worry about with her. She's going to be taken care of. Do you know your parents' situation? Have you ever sat down and talked with them? Do you know that you might be your parents' retirement plan? I was going to retire at 40, and then I saw my parents' retirement, and so I retired at 46. I needed 6 years to prepare for their retirement, and it ended up they didn't need it now that the house was worth so much money. But still, we're walking into a disaster here. People either gonna have to work longer, work to 70, 75, or they're gonna have to figure out how to live on very, very little money. Social Security is just not going to pay the bills, or they're going to be moving in with you or whatever. So we have a retirement crisis. We have a bunch of baby boomers leaving the workforce all at once. It's going to be an interesting phenomenon. So most workers in the 50s, 60s aren't prepared. They have Social Security, low 401k balances. Most workers will delay retirement if they can. I was working with one family, woefully inadequately prepared for retirement. So that was my answer. They had special needs sons. Both of them were probably going to be living and depending on their parents for the next 20, 30 years. And I said, yeah, your only choice, I mean, I hate to tell you this, you're just going to have to keep working. And they said, well, we have a lot of health issues. We really can't keep working. And I'm like, what do you say now? There was no solution for their problem. I had nothing to offer to them. And it was really sad, but their health situation was pretty serious. He really could not keep working in his state. And you have to say, wow, I really admire you. You adopted these two special needs kids, and that's really great. But now they're to the point where, what do we do next? And it's going to be tough. There's going to be a lot of really tough decisions people are going to have to make out there. And so the demise of the corporate pension plan was that one thing that really helped, I think, the most desperate. It's the one thing they had, that they had it mainly because they couldn't control it. They couldn't get their hands on it. And again, I don't think people raid their plans because they're undisciplined. I think a lot of people, just life happens, and that's 401k is pretty tempting. If these plans had always been managed the way life insurance company managed theirs, we wouldn't be talking about shutting these plans down. Everything would be fine. It'd be really normal. People would just be managing like they manage the life insurance, and would provide extremely reliable source of retirement income. Instead, people just have to work well into their 70s. It's just no other choice.
Yeah, so when you say, like if the way, like they manage their 401k would be the way like insurance companies manage their annuity liabilities, is that similar to like a retirement calculator where you calculate how much you would need?
Well, I didn't say 401ks managed like, this is the
Okay.
defined benefit.
Okay,
Yeah, I don't think 401k should be managed. We'll talk a little bit about that. That's where it's different. That's your money, but you have a large asset called human capital that your employer doesn't have.
Mhm.
So that's why it changes it. Your human capital, and we'll get into that, but yeah, that changes it. Your 401k should probably, if you're in your 20s, should probably just be 100% stocks and just go for it. The calculators will probably tell you 90% stocks, 10% bonds, which makes no sense to me, but we may talk about that. I think that's kind of a crazy allocation. But yeah, and then as you get older, as you get closer to retirement, you'll shrink the stock allocation. You'll become more like a pension plan as you get closer to retirement. But yeah, in your 20s, because of your human capital, you can invest a lot in stocks. And not to depress y'all, but I mean, this is something that's certainly going to be hitting the economy. There's a famous book out there. I don't know if I can find it. The Pig and the Python. Have you ever heard of that book? I think it's The Pig and the Python. See if it comes up. No, that's not it. Pig in the Room. Okay, well, no, there are some books out there. I don't know if it's still in print or not, but there's a very famous book. I think it's The Pig in the Python, because you know, a python swallows a pig and you can see the pig going down its body. That's what they're trying to say. And who is the pig in the python? Well, it's the baby boomers. So in the 60s, Gerber Food was doing great. In the 70s, residential real estate was doing great. 80s and 90s, stock market was doing great. Why? Baby boomers had babies. They bought a lot of diapers and baby food. In the 70s, they moved in their first house. They're buying a lot of housing. 80s and 90s, their kids are going off to school. They're starting to plan for retirement. They're buying a lot of stock. What happens when the pig gets to the end of the python? When they start savings, they start selling their assets. They start living off their assets. What is that going to do to stock markets? And that's the big question. And his book's out of print, so I can't help you with that anymore. Is it the pig and the python? Maybe, but that doesn't really make sense, does it? Oh, there it is, right there. It's the pig and the python. So yeah, famous book. I don't know when it's published. I don't know if he should update it, shouldn't he? You would think. It's only 256 pages, but 98. Yeah, I mean, he was talking about why is the stock market doing so well, and then his question is, well, what happens when they start retiring? Which I think it's a very skewed group of people. So senior citizens in the United States on the whole are the wealthiest group in the United States. They're far wealthier than young people. So I don't like all this tax subsidies we're giving older people because they don't really need it. But there's a lot of very, very poor, unprepared old people as well. So there's some really, really wealthy ones and some very poor ones. And we're giving a lot of tax breaks to the very wealthy ones. And a good example is the Affordable Care Act. It says you can't charge anyone more than 6 times their actuarial rate. What does that mean? That means young people are going to be paying 2 to 3 times the actual rate for health insurance. Does that seem fair? That you should have to pay 2 to 3 times as much for health insurance so that you can subsidize your grandparents who are living in a 6-bedroom house, driving 3 Cadillacs. Does it make sense that your generation is subsidizing some very wealthy people? I don't know if I'm saying they're all wealthy, but subsidized. But why do we do that? Because they vote. They get what they want, and they're pretty tenacious. And so we have this generation warfare going on. But yeah, his argument is just watch the baby boomers and you're going to know what's going on in markets. So the sense is the baby boomers are going to start selling all their stocks, start selling their big houses, downsizing, buying more bonds. What does that mean for markets? It can be bad for real estate market, great for the bond market, horrible for the stock market, but who knows? Because the baby boomers, a lot of them aren't retiring because they can't. So, it's an interesting phenomenon. And this is part of the problem. They're just not able to retire. So this is my argument at USAA. Let's manage it correctly, and we were managing it correctly. We switched, but the CEO said, no, I don't want to deal with it anymore. He shut the plan down. Now they still have a pension plan, but they shut it down for new getting new benefits. So they have a group there. So it's still probably a $2 billion plan, but it's just shrinking over time as people retire and die and go away. So the plan will eventually go to zero. And then they really massively increased their 401k plan. I forget what it was, but it was really pretty nice, like 8% match. You put in 8%, they match 8%. I mean, it's pretty sweet little deal. But you tell someone who's making 30, 40,000 a year, hey, just put in an extra 25% into your don't do 6, do 8. Like, okay, I got 3 kids and I got soccer. No, I can't do that. I'm not even doing the 6 right now, So again, these plans tend to benefit the wealthy or the struggling. All right, before we get into individual investors, I want to talk about this article. There's a lot of overlap with this article. So this is the Robert Arnott article. This is the one I asked you to read. This is my rewritten one. You can see he's taking the similar type of view as I am. Can we keep our promises? Can pension plans pay out what they promise? And he says in finance, we teach you all these wonderful things like standard deviation, beta, all these risk measures. He says, throw all that out. That's not what they're doing. He says there's 4 risks. Well, he says there's 3, but I'm going to say there's 4 risks that you manage when you get into finance. And here they are. Peer risk. Now, this is my rewritten one. He would switch between alpha and peer risk, but they mean the same thing. Because what is alpha? That's how much you beat the market. So peer risk is how well you're doing versus your peers. So it's this comparison. How are you doing versus the benchmark? There's asset risk. That's where standard deviation comes in. It's how volatile, but really it's just how much did you lose on your portfolio. ALM risk, we just talked about that one. There's 4 risks on ALM risk. Anybody remember the 4 risks? We talked about them last couple of classes. Longevity risk, interest rate risk. I got a cola in my hand. Inflation risk, right? Cost of living. What was the last one? Anti-selection. Sick people take a lump sum, healthy people take. So that's the ALM risk. He mainly focuses on the interest rate risk, mainly because that's the one we can manage. The others are a little tough. There's one other risk in here, and it's called career risk. He doesn't mention that one, but it's an extremely important one. And it goes very closely with peer risk. What is career risk? Career risk is, remember, you can get sued if you make a fiduciary mistake. As long as you do what everybody else is doing, you've got cover. So career risk says, I don't get fired. As long as I do what everybody else is doing, this job pays an incredible amount of money. As long as I do what everybody else is doing, I don't have to worry about it. Why should I be innovative, do things right? I'll just do what everybody else is doing. I keep my job. I get paid really, really well. That's career risk. And also peer risk is, as long as you're doing as well as everybody else, you're not falling way behind, you get to keep your job. Career risk and peer risk completely ignore the client. They don't care about the person you're managing money for, the beneficiary, the mutual fund investor. Forget them. We're worried about our relative performance, our careers, and that's the risk most people are managing. Robert Arnott says of these 3 risks, this is the largest one. Asset liability and risk. Why? Because when interest rates fall, that pension liability just zooms up tremendously.
So like, I don't know, do you think that in the world of finance, is there like not a lot of peer risk? Because I guess in the in a finance job, like a security analyst, you get to recommend stocks, and wouldn't you need to be like very short that start the year with commenting is the right one?
Well, I don't-
You get,
I was scared, and I don't know if any analyst that's all that confident the stock you're recommending is do all that great. So that is pure risk. If you buy the index, you don't have pure risk because you just go up with the index. But pure risk is you recommend a stock you think is going to outperform and it doesn't. And yeah, you take career risk, you take pure risk. Now, so what Arnaud is saying is, well, he's not saying some of this is purely me, but I'm adding stuff to his article just from my experience. So you got pure risk, which to me includes career risk. You got asset risk, and you have ALM risk. He says this is the biggest by far, but where do we spend most of our time? We spend 99% of our time here, 1% of our time here, and 0% there. Why do we spend 99% of the time there? Because that's how we're compensated. Is that shocking that people focus where their paycheck comes from? That's where the bonus comes from. That's how they decide whether they get fired or not. 99% of the time. What's the 1%? Once a year, you do an asset allocation study. You go to the board and say, hey, we decided to do what we were doing last year. Everybody agree? Yeah, we agree. That's not even 1%. I mean, it's like 30 minutes. You're done. And then ALM risk, most pension plans don't spend any time on that at all. They don't talk to the actuaries. They're not involved at all. They don't ask that question. Most of them don't even know pension plan accounting. They're just looking purely at the assets. So it's very, very skewed in the opposite direction. What did we do at UTSA? We eliminated those two and we went 100% on ALM risk. And we were happy, we were very happy about it. Our board. So it used to be before we were like everybody else. We go to the board meetings and we spent a lot of time. Manager A, this is how they're doing. Manager B, manager C, manager D. We went through them. These four are doing great. These five are horrible. Are we going to fire them? All this discussion of we fire them, we have to go to the board to approve the replacements. Oh, it's just a massive amount of work and energy. So we decided to index all of the stocks and then hire, very respectable managers on the bond side. On the bond side, they can outperform, underperform the benchmark, but it's usually pretty close. Like on the stock side, the market's up 20%. There's a good chance a manager only be up 12. You can be way, way off. But on the bond side, if bonds are up 7, your manager is going to be up somewhere between 6.5% and 7.5%. It's not going to be that dramatic. Asset risk, we kind of got that approved, so maybe that's the 1% sum there, but we made asset risk part of the ALM risk. And so instead of doing this big presentation, all these managers, this is what we did. Asset return, or 8.2%, liability return, 8.1%, alpha. That was one page. Multiple pages. This one page. Our assets are up 8.2%. Our liabilities up 8.1%. Any questions? We were done. It's like, wow, that was too simple. That's what we did. We focused all our energy right here, and it made life so much easier. My staff loved it because they actually hated this part of it because it is so much time. We were meeting with 400 or 500 managers a year, and it's extremely time consuming. And you never have any confidence you're hiring someone that's going to beat the market because there's just no predictability to that whatsoever. Very, very frustrating. This made a lot more sense to me, and the board they were fine because they didn't like the meeting anyways. They cut the meeting time for them down dramatically. We got rid of our consultant, which is costing us a few $100,000 a year for hiring these managers. It was just a piece of cake, very, very easy to do. So what would AT&T say? Well, but in 2021, this might have been 20%, and this might have been 15%. So you miss out on a huge opportunity. And then I'd say, yeah, but in 2022, this was like that. So, you know, you're going to take the risk to add all that alpha. You're also going to take the risk of really, really crushing. So my approach, I'm never going to be off that far. I'm going to be within 1%. With his approach, he could be off 20, 30% pretty easily. And that's why 2008, he saw plans going from a 20% surplus to a 20% deficit all in 1 year and just getting completely devastated. And is that a year you want to go to your CEO? I think we talked this last class. You want to, in 2008, everything's coming apart. And you go to the CEO. Oh, by the way, also our pension plan's down $500 million. Just to let you know, we're going to have to write that off at year end as well. And your CEO's like, give me a break. Can y'all please not do any more destruction this year? It's just frustrating. Does that make sense? Now, you may walk into a firm where you're going to be involved with a pension plan that doesn't do this. You can try the arguments I made. You'll probably lose, but hey, if you want to invite me to lunch and I have an out and out fight with your boss, that's fine. You're better able to win the argument now with interest rates higher. There's more plans thinking about moving this approach. They weren't all that interested when they could buy bonds at 2%, but now they can get bonds at 4 or 5%. It's a little more interesting to shift from stocks to bonds, but it's still a tough argument. All right, so here's what he talks about those different areas, and what he says. I disagree with this conclusion. His solution is on these 3 risks. His argument is balance them. Instead of 99% pure risk, let's kind of go equal between the 3. My argument was get rid of the 2 unimportant ones and just focus on the important one. But he said you got to find some balances. So he asked, does pure risk matter? So you got a pension plan and then it's up 7% and GM's pension plan's up 15%. Does that matter? My argument is no, it doesn't matter. My job is to pay the pensioners. If my liability's up 7%, my assets are up 7%, I did my job. I should be happy. Fortunately for me, I had a CEO who did not care what anybody else was doing. It made my life so much easier. In fact, for him, coming to him and saying, we want to do something no one else is doing, he's like, yeah, let's do it. That was like encouraging to him because he was convinced no one knew what they were doing. So he kind of helped my case a little bit. It's very dangerous from fiduciary risk. I was create tremendous fiduciary risk for all of us because we're so out of lines with everybody else. But it made more sense to us to do that. He shows the size of these plans. I think this is a little understated, especially the peer risk. I think is overstated. And I think the ALM risk is understated. I don't know exactly what assumptions he made, but his main point is with the new accounting for pension plans, you're going to really start noticing that liability, and it's not going to be 30 cents on your earnings per share. It's going to be $5 on your earnings per share. It's going to be a huge impact that the market is going to notice. So he's saying, yeah, this is big stuff. GAAP accounting's changed. It hadn't changed at the time he wrote this article. There's my figure. You look at his figure. Maybe I can show you why I think my approach is a little bit better. So here's his original article. Did I put his picture in there? I don't think I put his picture. I should have put his picture in here, shouldn't I? Yeah. Oh well. But there's Robert Arnott. He doesn't look like that anymore, but that's Robert Arnott, famous guy. So here's his approach. He puts 50 cash flows in. And I just think this is really hard to read. So what he did is here's the cash flows as a percentage of the total. Here they are undiscounted in blue. Here they are discounted in yellow. So obviously the earlier cash flows have a larger part of the liability than the later ones. And then he shows the interest sensitivity, but I just find this really, if this makes more sense to you than my chart, then feel free to use it. It's too many cash flows. It's hard for my mind, especially since I got to add 3.5%, like 17 times here. To me, it's just hard to get that together. But So I simplified it by just using two cash flows, year 3 and year 30, just to show you those long-term cash flows are very small part of the liability because of all that discounting. But when interest rates change, they're the biggest part of the volatility because of the duration. And that's exactly what he means. He talks about it being a positive convexity, which we talked about. So what is his recommendation? His recommendation, like I said last class, given that 15% of that liability is extremely high duration, just mitigate that risk using, he says, use long corporates and other things. I say you just use swaps. So he says at least get that 15% volatility out of that, because that 15% of liability is like 60-70% of the volatility. So by getting that hedged, you only have to handle 15%, you get rid of a huge chunk of the risk. The way he words it, let me show you his sentence. Yeah, he says most plans are holding too little in bonds, and the bonds they, well, let me show you how the way he says it, because his way I thought was a little confusing. It means most plans are holding too little in bonds that are too short in duration. That's a little bit tough of a sentence for me. I don't know if that, what is he saying? Most bonds are holding too little in bonds that are too short in duration. Are they holding too little in bonds? Are they holding too little in bonds of long duration? You know, it's kind of tricky. So I thought it was a little awkward. Now he's a very, very good writer. So this is his editorial. So it's not his full length article. So I reworded it. It means that most plans are holding too little in bonds, and the bonds they do hold are far too short in duration. So I broke his sentence up into two pieces. They should have a higher allocation to bonds, and the bonds they buy should have more duration, and that will get rid of a lot of your interest rate risk. But I disagree with this. I think you should hedge the whole thing. Don't just hedge that longest part of the liability, hedge the whole thing. Be like a life insurance company. Why do plans hold shorter duration? That's the inertia. The Lehman Aggregate Bond Index has a duration of about 4.5 years. That's the benchmark. That's what everybody buys. It's just habit. You get these habit forming going on. And plus, when you have 70% in stocks, it's the bonds kind of get lost in the route anyway. So yeah, it's. I wish he were here so I could kind of debate him, because I actually think he would actually agree with me. All right, questions up there, because I want to talk about what this means for individual investors. Does this make sense? I mean, this is an exam question, so you're going to have to put this into your own words. There's so much finance in this question, though. I love it. I love it too that the industry is ignoring it. Gives you a chance to debate theory versus practice. So corporations, governments should hedge out interest rate risk for the retirement plans. Does that mean you as individual investors should look like a life insurance company and hold 100% in bonds? The answer is yes, with two caveats. You have an asset that's a huge asset. It's called human capital. You remember the definition?
The present value of potential earnings.
Present value of your future earnings. And your future earnings look a lot like what? Your future earnings look very bond-like, don't they? You expect your earnings to be 150,000 one year, 20,000 one year, and 1 year you lose 50,000. Next year you make 70,000. Is that what you're expecting your pay to be? You expect it to be 80, 82, 89, 123, 170, 185, whoops, 160, okay, 185, 200. But it's going to be fairly predictable. You might lose your job every once in a while, but your earnings are fairly bond-like. There are jobs that are more stock-like, but definitely there are jobs that are very sensitive to the economy. If you're working Men's Warehouse selling suits on commission, yeah, that may be a very stock-like job where your pay is going to go up and down. But most of your jobs are going to be very bond-like. And that's your biggest asset. So that means right now you have 99-point-something% of your portfolio is in human capital, which looks like a bond, which means you have full reign to invest everything you invest in stocks, because it's still going to be a small part of your portfolio. As your human capital matures, you need to move more of your portfolio out of stocks into bonds to replace that human capital. So that's the argument for young investors. A lot of people say young should buy stocks because they call it time diversification, that over the long run, stocks aren't all that volatile. And that argument's absolutely mathematically incorrect. Actually, stocks get more volatile the more time there is, not less volatile. They're much harder to predict 10 years out than they are to predict 1 year out. It's just, I mean, if you have a $100,000 portfolio, the range 1 year out is going to be much narrower than your estimated range 10 years out. It's going to be extremely wide. The uncertainty grows and grows and grows with time. So stocks are very volatile things. So you don't invest in stocks because you're going to diversify over time. It's because you have an asset there that really diversifies you very, very, very well. And then human capital also has optionality. What that means is you can change jobs, you can go back and get a master's, change careers even. Some jobs have more optionality than others. So we have some actuaries in the room. Actuaries probably have the most optionality out there because they can easily switch. Well, some of you are taking John Tui's class. He went from an actuary to being a portfolio manager, went from actuary to finance. That's no way I could go from finance to actuary. It's just it'd be impossible. There's no way I'm going to sit and take 10 actuary exams at the age of 60. But he had no trouble switching from actuary to finance. Actuaries can switch from actuary to decision science. They can switch from actuary to management science. Their math skills are there. So pretty flexible. Finance, not quite as flexible, but probably more flexible than accounting. But that's what you're looking at, which means when you get skills, you need to get skills that move very easily, like Python, like machine learning, like AI, all these things where you learn how to use them. I have a student up in New York City. He's not in finance at all. He's got a finance degree, but he's doing logistics for New York Transit. He uses Python all day long. Why? Because he's got these massive databases. So he's gaining skills that could easily move to the auto industry, all these different places. So you've got to really think about this optionality that, you make sure you're picking up skills that if you need to move, they're going to go with you. You don't get so specific in your skills that you just, you can't do anything with them. So when you're younger, you have more optionality. As you get older, your optionality declines. So I actually think you should add optionality as you get older, to things like stock options to protect your portfolio. Those kind of things make a lot of sense to me because you're not going to switch careers at 70 years old. It's like, oh, you know what? I've been in finance my whole life. I think I can become a construction engineer. It's probably not going to happen unless you've had that background. So you probably can buy stocks. So let's do this debate. 20-year-old allocation. Boy, I wish I could type. Mrs. Quinius was my typing teacher. Did y'all take typing classes in high school? Did they not bother because you were typing at 2 years old?
We did middle school.
Did y'all in middle? Yeah, we did in high school. Yeah, I sat by the craziest guy because he couldn't type. So we had these electric typewriters, and you push the button and you turn the machine on, any button you push would move. So every time I came into class, he had every button on my machine pushed. And when I turned it on, Miss Queenie was like, what? What's going on? But anyway, I didn't learn how to type because he was messing me up. All right. So the standard is 90% stocks and 10% bonds. I think that's ridiculous. I wouldn't do that if I were you. First of all, your asset allocation is 90-10, but what is your risk allocation? Your risk allocation is 98-2 because stocks are so much more volatile than bonds. So you're not going to notice the bonds in a down market, but you're certainly going to notice them in a long bull market. You're going to say, wow, I could have been making a lot more money. So, and I tell you, y'all, somebody heard me say this before. I've never heard anyone in 2008, boy, glad I had those bonds. I only lost 33%. Could have been 35. I didn't hear anybody say that in 2008. When you lose 33 or 35, what did you do? You lost 30 of your money. The rest is rounding. So the bonds are not doing anything for you. In fact, bonds were down 15, 18% in 2008 anyway. So if I were you, I would just go 100% stocks. If it's choice between 90% stocks and 100% stocks, I would just go 100% stocks. Why mess with it? Or you can read my blog, go 90% stocks and then 10% crazy. Put a bunch of money into some new AI company or whatever, just have a play portfolio where you find a few, go to ARC's website and see what she's buying. Maybe put some money in there, who knows how good of an investor she's going to be. You don't have to be right most of the time. If you buy 20 stocks and 19 of them go insolvent and one of them is Microsoft, you just made a fortune. So you only have to be right 1 out of 20 times. So it's, so that's what, if I were you for that 10%, that's what I'd be doing, these kind of stick a few $1,000s in that company and just forget about it. And if they take off, they take off, that to me would be a much smarter use of that 10% than thinking I'm going to reduce my risk to some efficient frontier that you don't even care about. You're not even going to notice. But anyway, so I think you as a 20-year-old, since you already have a huge allocation to bonds anyway, that's your human capital, then go wild with that other money, especially when you're starting out. I have students like, oh man, I've started my 401k or whatever, my Roth, and I lost 20%. What should I do? It's like, just keep investing. You're not going to notice that 30 years from now. I mean, what you're doing right now is you can completely, if you're stressing about losing 20% on your $2,000 investment at age 20, trust me, when you're 45 and you have 1.7 million or whatever, it's like the $200 you lost in 2021 is not going to mean anything to you. So human capital, we talked about that. Life insurance is the perfect hedge for human capital, but you may not need life insurance if you don't have dependents. But if you have dependents, buy some term life insurance. That's not a bad investment at a young age. It's very, very cheap. Certainly would protect you from that. And then reduce your stock allocation slightly over time, or you can buy these target dated funds. They do that for you. As you reach retirement, they get lower and lower and lower. Not all of them do that though. I forget the name of the firm. They came and talked to us, I think it was 2006, 2007. And their argument was older people in retirement, 70-year-olds, they're still exposed to inflation. They could still live 20 years. We're going to put them 70, 80% in the stocks. I thought, you're crazy. I said, no, they need that long-term. I thought that was, in fact, it got so bad, my department stopped telling me when this guy came in. Because the two of us would just sit there and scream at each other. I just thought, that's insane. You're going to put a 70-year-old, that if the stock market falls 50%, they're going to lose, 35, 40% of the retirement portfolio at the age of 70. What are they going to do? But anyway, I don't know what they did after 2008. I don't think it went too well for them, but that just seemed crazy to me. So yeah, optionality, we talked about that. Here's the equation I use in my life insurance class. We can ignore that. All right, so there's my argument. Borrowing to invest. First of all, just having a pension plan makes your firm much more risky, because that pension plan isn't just debt, it's extremely long duration debt with extreme positive convexity. So you're talking about something that doesn't just add to your beta like debt does, it adds to your beta in a somewhat hypersensitive way. Pension liabilities have a lot of risks that are very hard to manage, but one of the risks is interest rates that we can manage quite well. So balance sheet immunization is a way to take this risk down. What does that have to do with the value of the firm? Well, if you borrow with the pension plan and put it in the stock market has a net present value of 0 or even negative because of active management fees. So you're not adding any value on the firm on the free cash flow side. You're killing the firm on the discount rate side. So you're actually destroying value by having this pension plan. But if you immunize the balance sheet, you reduce risk, you can counteract the impact of the pension plan by doing that. The firm would probably be far better off if it just gave the money to the employees. Just got rid of all 401k plans, pension plans. So we talked, I think last class, why do companies do this? They do it because of tax code. If it wasn't for the tax code, they'd be happy. They'd love it if healthcare wasn't so favorably taxed. They'd love it if these, I think most employers, I really think so. The departments wouldn't like it because they'd all lose their jobs. But I think most CEOs would like to just pay their workers. Here's your salary. We're not giving you anything else. No healthcare, no pension plan, no 401k. Here it is. You're just going to pay you. We're going to pay you 60,000 instead. We're going to pay you 110,000. But you're responsible for everything else. What's the worker going to say to that? Well, I got to pay tax and all that. And before I didn't, but most workers, how upset would they be? It's going to double their pay, but they're going to pay tax on it, but they're not going to get all these healthcare benefits. What is the argument the government makes? Well, they're going to buy bad stuff. They're going to buy stuff they shouldn't. They're not going to retire. Well, that's their fault. So I'm kind of just give them the money. But if you're not, I think pension plans can have a very good benefit to employees. But without the tax code, there's no reason for any of this. Employers should just pay their employees and let them do with their money what they should do. All right. Questions on any of that? I might show you an example answer on that one because it's kind of a scary essay question. There's an awful lot there. I'm kind of curious though, if let's say you're on the plane next week and the guy from AT&T is next to you and you get in a conversation, could you handle it? You take this guy on? I mean, he's like 6'7" or so, but do you feel confident enough to talk this? This is finance theory and practice. How confident this is. To me, this is why you go to college, is so you can take this stuff and you can apply it in a case like this. Because most of what we show you in finance classes, it doesn't show up on your desk like that. I'll assure you, your boss is not going to show up to your desk and say, here's Apple's dividends, here's their beta, here's the risk-free rate, here's the market risk premium. Could you, over the next couple of weeks or so, plug this in a dividend discount model and give me a price? You'll never get that in the job. Guess what? You got to do all of that yourself. Not only that, but you got to know to do it for Apple, because your boss isn't going to tell you that either. Finance, you walk in with nothing. Like me with a pension plan, they hand me the pension plan. It's like, wait, what is this thing? I look at it and say, wow, it looks like a life insurance liability. So I go talk to my friend John. He says, you guys are idiots. Well, okay, John, you're a really smart guy. That makes me nervous. I go talk to our actuaries on the pension plan side. Yeah, you're exactly right, Ron. We shouldn't be managing like this. I'm glad no one's from the investment side has ever talked to us before. We all get together. To me, it's pretty exciting, pretty fun. But I had all this finance theory in the back of my mind going, wait, what is this doing? Should we really be doing like that? So, to me, it's the cool part of finance, but you see the ambiguity of finance, kind of the freelance nature of finance. It's just, everything's a blank sheet of paper and you go for it. But most of our industry does what? Let's keep doing what we've always done. Let's do what everybody else is doing. That's not the fun part of finance. You're not going to add value by doing that. You're not going to change the world by being conventional. I'm not saying change it just to change it. That wasn't what we were doing. We actually believed what we're doing. But you certainly have to ask, does this make sense? And that's why they hire you out of college. They want you asking, does this make sense? Should we really be doing like that? Because the old fogies like me, we kind of get set in our ways and we don't ask those questions. So you have to be careful. You can't go overboard, running to the CEO's office, telling them what we need to do. All right. No other questions? No questions? All right. I was hoping for questions. This is like the most exciting topic. I love this topic so much. So.
Is there like a statistic on how frequently pension plans have failed?
Well, pension plans failing. So if you go to the Pension Guarantee Corp's website, they may have data like that. It's a government plan, so they should be telling us, there's taxpayer money that's actually bailing these things out. So yeah.
Google, and they just have like U.S. News article, like 10 biggest failed pension plans.
I mean, that's the other side of this is if you invest. So that's to me a real key to this. If I probably should put this up there is who's managing what risk. So if you fail in putting all this money in the stock market, the beneficiary loses out because then their pension plan goes to the PBGC. The taxpayer loses out. The only people who doesn't really get hurt are the people that made the mistakes, as long as they don't get sued, and they don't get sued because they're doing what everybody else is doing. So we've got really bad incentives in this industry, and that's part of the issue. You got to change the incentives for people to do what's right, and then the taxpayers have got to kind of complain that they're bailing things out, you know, when people are essentially rolling the dice. Other questions? All right, so one last thing I want to show you. This, you may want to make sure you're sitting down for this one. So I'm going to show you USA's pension plan and what happened, because it was like a 1 in a million year. So we hedged our pension plan, not the 14% long duration. We hedged the entire thing. We went from 70% stocks to 80% bonds. We had a little bit in stocks, but not a tremendous amount. The stocks were all indexed, so we're paying like a basis point for that. And then we hedged it with swaps. So we had some basis risk. All right. Here's the discount rate for the pension plan. And here's the swap yield. What does that correlation look like? Greater than 0.5 or less? Greater than 0.99 or less? Probably less than 0.99, somewhere in the 0.85, 0.9 range. Not perfect, right? A little bit of noise. So here the pension plan is skyrocketing. Here the swap is skyrocketing, but you notice there's some places where they're not quite lined up. Here you would have been really happy. The pension liability would have dropped and your swap would have gone up, but then you would have given it all away the next week. But fairly well matched. And so that's what we did. And then 2008 came along. Are y'all ready for this? Y'all sitting down? So here's 2008. Corporate bond spreads gapped way out and swap spreads collapsed. I watched this swap. I was watching it every single day. It went from like $50 million to $500 million, like in a nanosecond. And our liability dropped several $100 million. So we had the swap that was hedging, worried about the liability going up. So the swap goes up $500 million. The liability drops several $100 million. That's when a hedge blows up in your favor. So just think of it going the other way, how embarrassing that would have been. I would have retired a little earlier, maybe. Yeah, that was, I don't think, I can't go back that far in history to see if that had ever happened before, but yeah, just absolutely insane. So my recommendation was that they sell this and buy that. We actually met on this day. Unfortunately, I wasn't responsible for this anymore. I said, sell the swap and go out and buy bonds, BBB bonds. And they didn't do it. They waited to somewhere around here, gave up a few $100 million waiting. Their argument was, and this is kind of my frustration, their argument was we need to do a study. That's like, I don't think you need to do a study. Now we're sitting right here. Obviously it could have kept going, but it didn't. But I had the entire investment company behind me. Everybody in the investment company, y'all should sell that swap. And their argument, we got to do a strategic asset allocation study. I said, great, do a strategic asset allocation study. There's nothing strategic about this. This is 100% tactical. Sell the swap, buy the corporate bonds, and it would have they would be a few $100 million better off today if they had. They still did extremely well. I mean, it's no question they did extremely well. But yeah, just crazy situation. Obviously, it helped a lot that they had very little in stocks, so that helped a lot. The stock market was down, so they didn't lose that on the stock market side. But yeah, their pension plan, even moving late, their pension plan went from a $300 million surplus to a $900 million surplus. That's kind of nice. You're going to a brand new CEO who takes over in the middle of a major financial crisis, and you can go to him and say, hey, our pension plan, it's actually up $600 million. And he's like, one thing I don't have to worry about. In fact, USA's net worth increased in 2008, and it wouldn't have it hadn't been for his pension plan. So he was it was one, I think there's only two financial institutions whose net worth increased, MetLife and USAA. And it's partly because this pension plan was up a pretty healthy amount. But yeah, what do you do in these cases? So, and their first argument was when we first started talking about it, I started talking to them while it was starting to break down. They're saying, well, we're hedged, we don't need to do anything. And I say, well, yeah, you're hedged, but this is something different. When your hedge is making you hundreds of $1 millions when it's supposed to be making you zero, right? Your hedge is supposed to offset, and instead you're making a fortune. You're no longer hedged. There's something going on. Don't use that. That's just, to me, a ridiculous argument. We don't need to do anything because we're hedged. Just doesn't make sense to me, but that was their argument. And so they told the committee, I remember right in here, they told the committee, these are paper gains, don't worry about it. And my boss came back and I said, they're not paper gains if you sell. They become real gains if you sell. There's no reason we shouldn't be thinking about selling this. And he slammed his fist on the table. I didn't know he's mad at me or what, but no, he's mad at them, but fortunately for me. And then when this happened, I said, if you guys don't sell, you're crazy. So we met and I still couldn't convince them to sell. They still waited, but you've got to be paying attention. Just because you're hedging, you got to be paying attention. You got to be looking every day. These markets can really get out of whack. So this is called basis risk. We thought these two things were going to move together, and they didn't. We were just very, very lucky it moved in their favor. Just an incredible amount of luck. All right. Questions on any of that? I love this article. I do highly recommend Robert Arnott. I don't know what he's written recently. Smart beta is his thing. So you can read about smart beta. Show us your portfolio.
Special reports.
Yeah, commercial. That's what it looks like now. Investing in a new era of inflation. That looks like a pretty interesting one. That's just back December. I actually want to go watch that right now. It's an hour 24. I might be listening to that on my bike tomorrow. Value investing is back. Some people think smart beta is nothing but value investing. I don't know if y'all know what smart beta is, but it's finding different ways to build an index that's not related on market cap, some other measure. But it's, some people say that's just, or even better, Robert Arnott versus Cliff Asness. Those two are good friends and they argue with each other constantly. There it is right there. Factor fight rages between Asness and Arnott. Two of my favorite writers. Asness is at AQR. They highly respect each other, and you would think they hated each other's guts because they fight so bitterly, but they fight in a really good way because it's very educational. So yeah, so when you start college, you're reading textbooks. Somewhere around your junior year, you stop reading textbooks and you start reading this stuff because it's far more valuable to you, because they're talking about what you learn in your finance class, but they're talking about it in a way that's very, very different. And you start picking up on that and go, wait, I heard that in my corporate finance class. How are they using that? Wow, I remember that term. How are they using it? And you start becoming a finance professional and not a finance student. It's really quite. Robert Arnott versus class emphasis. Should investors try to time? You know, there's those two guys are just they're incredible to listen to because they say stuff that immediately gets you thinking strategy wise, how you should manage risk, how you should look at markets. Very brilliant people. They've been in the market for a long time. They have a lot of good ideas. Very quantitative, both of them. These are not you know, lightweights when it comes to mathematics and computer and programming. They're very skilled professionals, and they're people you should be listening to. All right. Well, I hate leaving this topic. It gets me so excited, but I'm not gonna look up. If y'all look bored, it's gonna depress me the rest of the evening. So I'm gonna keep going. All right. What about a life insurance company? Life insurance, in my opinion, is the hardest one of all of them. And the reason it's the hardest one of all of them is they give a lot of options to their customers. And when you give someone an option, it's just like stock options. Essentially, you're selling someone an option. You know, selling options is a really dangerous thing to do. You can lose a lot of money. That's what insurance companies do. And in fact, a lot of people argue life insurance companies give options away for free to their customers. And it causes them incredible risk. It's called disintermediation risk, which means there's certain markets where people pull money out of life insurance companies and move them to banks. And it happens at the worst possible time. I actually think life insurance industries are set up for a major catastrophe right now. They did really well in 2008, and they've been doing well recently. They've been picking up a lot of assets, but they've been picking up a lot of assets when interest rates are low. Their big disaster, if its interest rates shot up and stayed up, they would be in a lot of trouble. And that's kind of where we are right now. Right now, it's not a big problem yet because bank CD rates really haven't risen that much. Bank CDs aren't paying the 5% yet that I've seen. Have y'all seen 5% CD rates yet? But if banks start offering 6-7% CD rates, if rates keep rising, people are going to look at that 4% annuity. So you know what, that 7% CD looks awfully good, and they're going to start pulling money out, and it's going to devastate this industry. So very difficult thing to do. You want to be competitive. And by being competitive, you offer a lot of bells and whistles to your customers. Most of the time they don't use them, but then when they use them, it's at the worst possible time and it just wipes out the entire company. It's a really dangerous industry. That's the reason they do this with actuaries, because the math is really quite complex. It's hard to model what a customer is going to do if interest rates do a certain thing. You got to model what are banks doing? What are other insurance companies doing? What product are they in? What's our protection? I remember when I started at USAA, they had something called legacy annuities. These are annuities that had these really high guarantees, like 5% guarantee. We can't pay you less than 5%. That would be really good right now, wouldn't it? And then interest rates started falling, and they had, billions of dollars in these annuities with a 5% guarantee. And guess what the customer was doing? They were clinging on these things for dear life. Like, I'm not surrendering this thing. And USA is like, well, we got this other product, it's paying 5.2%. It's like, no, this product's the lowest I can go is 5%, and rates are falling. They were clinging on to those things. And it was just devastating because their portfolios were maturing. So they had these bonds they're making 9% on that they're now reinvesting at 6% and 5%, and yet they're paying their customer 5%. You can't make much money if you're making 5 and you're paying 5. Because you also have expenses and other things. So it's quite the disaster. They supposedly fixed that by reducing their minimums, but I bought some annuities from USA in 08 where the floors were 3.5%. And I was clinging onto those for dear life. And when interest rates hit 0.5, I finally rolled them over, but it's like, you're paying me 3.5% and you're making 3.5%. I just thought it's just too good to be. The starting rate was 6, and it was too good to be good. I bought a few of their annuities. Just I thought, oh, they're offering me way too much, and I got this floor of 3.5. Why wouldn't I buy this bond? It's just like too good of an option. So what life insurance companies have to do is what they call key rate duration and even key rate convexity. They have to match buckets of cash flows because those cash flows can move so quickly. So it's a very precise type of measurement. The models they use are using very sophisticated interest rate theory types of modeling, arbitrage free type of modeling. So it's quite complex, advanced stuff. And even then, they can't get it perfect because there's just too many uncertainties, too many unknowns. So it's a very difficult business. We might be seeing, if interest rate right now, they're probably okay, but if interest rates keep shooting up, especially if you see the 10-year above 5 and stay up there for a while, this industry, I think, is going to have a major crisis of defaults. And it's not a small industry. See, MetLife, I've heard of MetLife. Let me find them on Yahoo Finance. They're not as big as the banks. So 800 billion, but look at their equity. 68 million or 68 billion, not million, 68 billion. That's less than 10. I mean, that's more than 10 to 1. And these are entities that will absolutely crush if interest rates rise and stay up. So there's not much room for error, and they've got a lot of error that they're going to face. Now, if interest rates, essentially in my life insurance class, I don't know if you remember, Joshua, we talked about these annuities being like short straddles. You know, remember what a straddle is? The straddle is that big V. So a short straddle is like this. And that's what life insurance is. It's a short straddle. So as long as interest rates stay within a fairly narrow band, they're very profitable. But if interest rates move a bunch, they quickly go to huge loss situations, and they don't have much room for loss. I've seen some markets where insurance companies were technically insolvent if you marked everything to market, but at that time they weren't marking things to market, and so they were okay. But there's been crises before we didn't notice simply because the accounting was different. So we're not going to do life insurance. Do we have expiries in here? We have 1 or 2 in here. So if you do the life insurance actuary, I mean, this is a major actuarial function. What about endowments? I do want to spend a little bit of time on endowments. So we inherited the endowments at USAA. I had a department of 2 people, and we just went around USAA saying we want every portfolio. We just fought hard. And on the endowment, it was kind of a little embarrassing because the person that was managing it was the investment company that I used to work at. And at the end of the meeting, the CEO turned to the lady running the endowment and says, "Do you want him or do you want him?" And she picked my department, and we were really happy, but we didn't look at the other department. We just left, and we said, "Okay, we got this portfolio." We're really happy because we really wanted to manage it. And the reason she wanted us is we put a lot of time into it, and they were kind of messing with it, not really looking at it. We put some time into it. If you know what an endowment is, they're essentially charities, and they raise money for some charitable cause. Most of them are 60% stocks, 40% bonds with short-term bonds. So we're kind of out of time, so I don't want to get in the middle of this, but start thinking about that liability. When does that liability mushroom? When is it not going up? If you're a charity, do charities see their liabilities rise in the 2008 crisis, or their liabilities fall in the 2008 crisis? If you're helping the homeless or the poor or the indigent. So think about that, but we'll do that next class. So I want to give you a little bit of a sense of why this is such an important issue. This is an article in Market Watch. We'll see if they let me continue the article. But a lot of people are saying, you know, I'm going to work later because I want to, and they're questioning if they want to or they have no choice. Most of the workers have insufficient savings to fund retirement and the health crisis. Study employment extenders about their key reasons for working past retirement age. Majority said they just wanted to. Yeah, right. Most of these career extenders don't have enough savings. Could be denial. They're not facing the reality of the situation. The numbers, the dollar amounts are just really scary. If you look at here, the labor participation rate. So some of y'all took my investment class. We know the labor participation rate has been dropping. It's much lower than it has been, but that's not true with older workers. We look at this from 65 to 74, 32% are going to be working. That's up from 19% in 2000. That's a pretty large increase in people 65 to 74. Now it could be health. I don't know if life expectancy is that much greater in today than it was in 2000, but this article is somewhat implying that it's financials. 60% said they have less than $500,000 in savings. Yeah, you're not gonna make it very far with $500,000 even with Social Security, and that includes everything. 3 in 10 have less than 100,000. It's like, yeah, you have less than 100,000. You're not working because you want to. You really don't have any choice. There's no place to go. I was at a Subway, and the lady that helped me, she looked like she's in her 80s. You know, is she working because she needs the money or because she just wants to work? Would any of y'all work in a Subway just because you're? I guess if you're lonely and live alone, maybe a Subway. I could find something better than a Subway that doesn't pay well, but that would be sad. You know, to see someone working at a Walmart or Subway in their 80s because they just don't have enough. That's pretty sad. could be family situations, some emergency or something. It may not have been just planning, you know, things come up. So, you know, none of us really want to be in that place. So yeah, and that's why I say some of these are your parents, which is why you've got to be, aware that you may be their retirement plan. This one I got out of Wikipedia. What I saw was interesting here is just some of the numbers they give.
Oh, absolutely. Run the ball, 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 run the ball.
Thanks.
Yeah, good play, Kendricks.
So which one it is? All right. The state pension shortfall is somewhere between 700 billion and 3 trillion, depending on what discount rate you use. Does the discount rate you use change your liability? Oh, let's use, I mean, does it change the actual cash flows you're going to pay out? It doesn't, I mean, it just changes how you reflect it today. But why discount rate? I think they should use a treasury discount rate because there is no credit risk in these pension plans. And remember with the liability, the higher the discount rate, the more aggressive you're being. Lower is more conservatism. To be conservative, even the treasury wouldn't be all that conservative because, you know, you got the problem with longevity and these other things. So yeah, we're somewhere between 700 billion and 3 trillion, you know, plus or minus a few hundred billion. The shortfall emerged after 2000 due to tax revenue declines and 2 recessions. States, this is huge for states. The reason this issue doesn't get too much press is that it's not an immediate issue. They're going to make it another decade or so. Same thing with Medicare, making another decade or so. The problem is there comes a point in time, they've been saying this about Social Security, there comes a point in time where there's no solution. That's somewhat where Japan is right now, I think. There's just no solution. There's no way anyone can afford to get you out of this. So your only hope is to cut benefits and start means testing, those kind of things. But politicians don't have to worry about 20 years from now because they only have to get elected the next elections. So it's not the ideal type of problem for politicians to deal with. But yeah, it's a pretty serious problem. I wish I had that website I had before. And then this one I just saw. Here's a PBBG, 36 billion. How do I get rid of this guy? They may not let me look at theirs. Sometimes they kick me out. $36 billion pension fund bailout. A government bailout, the 36 billion bailout of 360 members. So 36 billion. That's a big number, isn't it? 36. And for 360,000 people. So it's only $100,000 per person. It's not a tremendous amount of money there, but the bailout here is us. It's taxpayer bailout, but since we have a huge deficit, it's not us. It's not my generation. It's your generation that's going to pay for it because my generation, you know, we're not going to pay for anything. So we're leaving that to you. The largest, so, you know, politicians are trying to make it sound like they did a really good thing. Largest ever federal financial support. Notice what word they avoided. They didn't use the word bailout, did they? Support sounds a lot better. Support for worker and retiree pension security. That sounds so good. It's a bailout. The only change in behavior the bailout requires is that the employers are now prohibited from cutting their contributions going forward. So they can't, since they can't rip off the federal government. That's a lot of money. The word bailout is kind of interesting. I think I saw a debate on Facebook. Y'all may disagree with me on this. They said, if we can bail out the banks, why can't we bail out student loans? But the word bailout with the banks was they were loan money that they paid back. So it's a little bit different. So this is a bailout. There's some bailouts where people are given money and they never pay it back. There are some bailouts where they're paid money. So the government actually made money on the loans they made to GM and AIG and others. The downside for the taxpayer was they didn't make an adequate return. It wasn't risk adjusted. So they were essentially got a really sweet deal, but they still got the money back. This is money you're never going to get back to the federal government. This is just money that's going to go to these workers. And what's frustrating is if they had managed this like a life insurance company, we wouldn't be bailing them out $36 billion. So you think about it from a state standpoint, they get a lot of good voters to vote them in office because they're given this wonderful pension plan, and then the state doesn't have to pay for it because they mismanaged it, and so now the federal government pays for it. It seems like a pretty good deal for the states. This to me is the most amazing thing. This is the funding level. 2022 funding level should have shot up because in 2022 interest rates shot up, so liabilities should have nosedived, and yet the funding ratio went from 91% to 80%. Why? Anybody guess? Why did funding levels drop? What were they invested in? The stock market. Yeah, so it's just yeah, they should have done really, really well last year with their liability dropping so much. If they've been balanced, if they've been immunized, they should have just stayed the same, right? They would have lost money on their bonds and on the swaps, but their liabilities would have come down the same amount, and they would have been perfectly fine. Yeah, that's pretty amazing that they could drop. This isn't 2008 either. If we had had a 2008, I mean, can you imagine just how much money they would have lost? The stock market was only down 19% last year, not 30-something%. So, I mean, these are real problems that we're not handling very well, partly because they are political problems, and politicians have incentives that are not very long-term in nature. All right, let's talk about endowments. So we've talked about banks and life insurance companies. So endowments. So if you think about here, your assets are investments. Endowments are notoriously 60% stocks, 40% intermediate corporate bonds. That's just where endowments have been forever and ever and ever. And then the liabilities is charitable support. So if you think about a 2008, what's going on with the assets? Whoa. So the assets are falling, prices, both stocks and bonds. We're going to get into this later. They didn't hold treasuries, they hold corporates. Treasuries were up, corporates were down. We're going to get into that when we watch one video I'm going to have y'all watch. It's one of the biggest lies we tell in finance is when we're trying to convince people diversification works, we use treasury bonds, but then everybody doesn't buy treasury bonds, they buy corporate bonds. And we never talk about the fact that those are actually two really radically different asset classes that perform very, very differently in a 2008 crisis. Falling prices, what else do we know about the assets? Well, you have donors. What are the donors doing? They're cutting back, yeah. They lost 30-40% in the stock market. They're sure not going to be donating money. So that the endowment's in a lot of trouble. What's the liabilities doing? Increased support needs. Right? It's a bad economy, whatever you're supporting. It depends on what you're supporting, but a lot of charities are probably seeing an increased demand. It was what we call the perfect storm. Have you ever heard that term before? Perfect storm. Just everything aligning. Really, really horrible year for endowments. My solution here was go ahead and do stocks, but you should hedge the stocks in a situation this for the really, really tail events. You should make sure you're not exposed to these massive tail events. I spoke to one charity. It was a pretty small charity, but you know, I think a couple $100 million, so not massive, but that was my recommendation to them. They kind of liked it when one guy on the panel, he just, oh, you're just playing games or smoking mirrors. And I was like, no, this is, the stock market falls, this actually pays you. This isn't kind of some kind of game. I don't know what his background was, but they were interested in it, but I don't know what they actually ended up doing. But this is not, I don't think this is a well thought out strategy for endowments. I think it's just, that's what, it's kind of inertia. That's what they've always done. There's not been a lot of thought behind that, but it's, so you're noticing a trend with how I think about risk is you need to do extreme scenarios. And we'll talk about this more. I believe you understand risk at the extremes in the tells. And I don't mean at that 1%. I mean at the 0.1%. Go out to the tells and really ask what's going to happen. What if the stock market falls 50% and interest rates rise? That didn't happen in 2022. The stock market fell 20% and interest rates rose. But 50 and 20 and 50 and rates rising, you know, it's just a more extreme. But we got that scenario last year. That's pretty bad. We don't usually think about that, right? Because bonds are supposed to be our diversifier. But we didn't see that last year. Stocks fell and bonds fell in price fairly dramatically. And last year, unlike 2008, treasuries and corporates fell last year. So it was every bond. There was no place to hide because inflation is that kind of horrible thing. So you have to think through those scenarios. And then someone says, well, that hasn't happened in 30, 40 years. Well, yeah, but we've also had falling interest rates since the 1980. You know, is it going to keep falling when the 10-year hits 0.5%? That's when I was shorting treasuries, is when it hit 0.5 on that day. I was like, it could go lower, but it can't go much lower. So this is a good time to short the market.
So I think how do they how it working out? Is good. It's like coming in the bird.
Well, you can use stochastic models where you run, you know, 1,000 scenarios. Anytime I did a stochastic model, I'd always say, okay, you're running 1,000 scenarios. What was number 1,000? And I say, oh, the stock market fell 30%. I remember one model's like that said, your worst case in 1,000 years is the market falls 30%. The tails don't go far enough. I need something 50% or more for that to happen. You can just, we did just do scenarios. Like, what if this happens? A lot of times, especially the CEO I had, you know, pretend 2008 happens again. Pretend 1973, 74 happens again. You have that data. That's, what do you banks call that? You remember? Stress test. So you can do stress tests. The problem with stress tests is there's no statistics. You run 73, 74 again, what's the probability of that happening? No one really knows. You know, interest rates shot up. We had a lot of inflation. Stock market fell, kind of like 2022, but very different from 2010. The market fell a lot more in 73, 74 than it did in 2022. So stress, that's the downside of stress tests. You can't put any statistics or probability to it. Whereas value at risk, you're at least putting some statistics. You might not trust them. So value at risk, the problem is what your bank's using, a 5% risk. They 95, did they say 95%? Isn't that what Goldman is? 95%? That's not, you're not very far into the tells at 95%. So I say go to the extremes. What if oil prices hit $200? What if the 10-year treasury hits 10%? What if inflation hits 8%? What if the VIX hits 50? What if the stock market falls 50%? You go through those scenarios and you see what's the impact. If your firm goes out of business, then you're going to have to say, okay, we can't have that scenario. So we're going to need to buy some kind of insurance to make sure that doesn't happen. Yeah, so David, you might be getting to the point of you run stress tests and they're not good. And then what do you do? So you got to do something. And that's the hard part. What are you going to actually do? So anything you do, so insurance costs money. So anything you do is going to reduce your expected return. So you have to decide, if I told you you're not going to have any auto accidents or any kind of auto event for the next 50 years, would you buy auto insurance? Why not? Why not just cancel it? I mean, save the money, right? It's costing you money to buy auto insurance, but you do anyway. So there is a cost to risk management that you have to accept. And when you're talking about something that only happens once every 100 years or one every 1,000 years, you know, going to extreme, and your boss is going to think, okay, it's going to cost me this much. And you're telling me there's a pretty high probability it's not going to happen during my tenure. So yeah, I'll roll the dice on that. If it happens, I'll go work somewhere else. that 1 in 100 chance. If it doesn't happen, I got better returns, even though I'm somewhat willing to die. So it's risk management's always a tough one to manage. But I at least got a chance to talk to an endowment and try to get them to at least think differently about it. And the board was generally with me on it. So yeah, there's all that discussion there. So part of this problem here is the 5-year bonds. So when you have 60% in stocks, that's a pretty risky asset class. And then you put 40% in bonds, but there's kind of 5-year duration. There's not much kick in that 40%. So that 40% is not going to really help you all that much in an extreme scenario. You either need to take more duration, or you need to put some crazy stuff, 5% or something pretty wild there on the other side. That 60-40 is kind of a boring allocation. That's just the 40% is just not losing money, but it's not helping give you a kick on the other side. So what are you going to do instead of that 5% in bonds? You need something that in a major crisis is going to be at 40-50%. The most obvious thing there is options. Options do that really, really well. They lose you money most years. They're just like buying insurance. They lose you money, and then when they make you money, they make you a massive amount. But you need something allocated in there that's going to give you some kind of kick. So my approach with the endowment was, let's go 100% equities, but hedge the equities. And I'll show you the numbers on that later. I think that actually has a higher expected return than 60% stocks and 40% bonds with the stocks unhedged, but we'll talk about that. Allocate 90% equities hedged, and then do something pretty radical with that 10%. Maybe some hedge funds, maybe some, I don't know, some infrastructure, something that's pretty unrelated to anything else, maybe emerging market debt, who knows what. You got to make sure it's truly unrelated. So maybe 90% hedged and then 10% radical. And that could certainly work. You're thinking about a weak economy, but right now we saw in 2022 a weak economy with rising interest rates. That's like the hardest one of all. That one just kind of we're out of weapons on that one. So I don't know. You can't just kind of be short duration because you have a weak economy, rates fall. That's going to really hurt you. So it gets pretty tough. Anybody know what this is called? You heard of Taylor? What is it called? You have something in your portfolio that's going to be massive, but the rest of the time it's mediocre or loses you a little bit. Black swan investing. Have you ever heard that term before? So mediocre. I can't spell mediocre. Most of the time and home run when needed. That's that kind of approach. There is a great YouTube video. See if I can find it. I hate going to YouTube with y'all all watching me. So see if I can find it here. Oh, here it is. Yeah. I highly recommend you watch this video. It's Kahneman. Y'all ever heard of Kahneman? He's the one that did Thinking Fast and Slow, a really famous book. So have y'all read Thinking Fast and Slow? I highly recommend that book. And then you have Taleb. He wrote Black Swan, Anti-Fragile, Fooled by Randomness. So this is pretty cool. You got the two of them in an interview. Kahneman, he's a Nobel Prize winner in economics, even though he's not an economist. He's a social scientist. And Kahneman, Taleb, who's not a Nobel Prize, they got the wrong person interviewing the wrong person. But Taleb, who's just a writer and kind of outspoken writer, he wrote Black Swans. So he's testing. We're going to talk about Anti-Fragile, the book Anti-Fragile, later in the semester. It's a pretty brutal interview for Taleb because Kahneman. I'd recommend if you're ever asked to be interviewed by Kahneman that you turn it down, because he asks questions and in his follow-up kills whoever he's interviewing. It's just he comes back with a follow-up that simply points out what the guy just said is pretty idiotic. And then he'll say, but we can move on. And so after he's just devastated this poor guy, he says, oh, well, let's move on to the next question. So you can see how relaxed he is. He's a very brilliant man. His mind works really fast. And he's just you can tell Taleb pretty fidgety this whole time. He was really in the hot seat. Not that anybody would want to be interviewed by Kahneman anyway, but it's a really good interview, hour and 18 minutes, really worth your time. You can tell Kahneman's not buying this idea of being mediocre for 9 years and then hit it out of the park on the 10th year. Kahneman's asking the question, can the average person out there really do? I mean, you're a rich person with all these best-selling books. You can afford to have that kind of strategy. Can the average person out there that's woefully inadequately invested for the retirement really get away with what you're talking about? So it's an interesting interview. Highly recommend it. But that's essentially the idea: is be mediocre most of the time and be fine with it. Everybody else is up 20%, you're up 12, 13%. That's fine. And then the 2008 comes and you're up 50, 60%, and that offsets all those other years. That's the idea. I call it smile when everyone's laughing and laugh when everyone's crying. It's the way I define it for myself personally. It's an interesting approach. I can get away with it because of my situation, but can the average person, for you, those of you that are in your 20s and investing, I'd say just stick all your money in stocks and forget about it for 10, 20 years and then come back. But for your parents and your grandparents, people in their 50s and 60s, they need to really start thinking about these type of strategies because our industry doesn't really help them with that. So, but I'm a big fan. We'll talk about options and what you can do with options. So why doesn't the industry really focus on balance sheet immunization? And it has to do with career risk. They don't do it because so few people are doing it. So the prudent expert rule, which you guys will be under, prudent expert rule says you need to use the care, skill, prudence, and diligence and act in a way that someone familiar with such matters would act. The easiest thing is to just do what everybody else is doing, rather than questioning what we're doing, what we should be doing. You just do what everybody else is doing. So it creates a herding mentality. It tends to argue against unconventional approaches. Your career is safe as long as you fail along with everyone else. The worst thing you can do is fail when everybody else is doing well. So it just really discourages any kind of innovative thinking. And it's still the rule today, mainly because that's how we're compensated as well. You're not going to lose clients if you do what everybody else is doing. You keep the money, you keep your bonuses. So it's something you guys will have to fight against, and just always be questioning. You have the right to ask, should we really be doing it this way? When you come into a new job and just have some guts. You may wait the third week on the job and not do it the first day, but at some point, start questioning. You should question it so they don't get defensive. So don't question it. Why are y'all doing it like that? That doesn't work. But can you help me understand this strategy? And then ask questions. Well, what if the stock market falls 50%? How's the strategy? What are your clients going to do? How are they going to react? Those kind of things. Ask those type of kind of obvious questions. All right. So that's interest rate risk, my favorite risk. This is one area where I think academia is right and practice is wrong. We're going to see when we get to price risk, the exact opposite, where I think academia is wrong and practice is wrong as well. So I'll show you that. So let's get into liquidity risk. So your banks have liquidity risk. And I bet you're reading it and going, I don't know if they're really doing anything. You're kind of like, yeah, is there really a strategy? Because liquidity risk is a tough one, really difficult risk to manage. Unlike interest rate risk, where there's really good tools to manage it. And 2008 changed our definition of liquidity risk. So in 2008, liquidity risk was you need cash and you get your hands on cash quickly without having to have a fire sale. That used to be the definition. And a fire sale means the very act of selling that asset causes its price to drop. I'm not talking about 2008 stock market drop. That's not a fire sale. All stocks dropped. A fire sale is when the security is priced at 90 and you have a big chunk of that security and you sell it and the price falls to 60 because you're selling so much. There's just not enough liquidity to buy that asset. That definition changed after 2008. After 2008, the definition changed that illiquid assets don't fall 20%, they fall 80%. So even if you don't need to sell it, when an asset falls 80%, you're going to notice it. It's going to be pretty dramatic. And that was what was happening in 2008. It was really wild in 2008. I was on a committee that almost never met. I was 3 years in, we'd never met. The committee was supposed to meet anytime a bond's price fell a material amount. We had to decide how to put it in the mutual fund. I was the equity guy, so it was like, it's not my problem, but I was on the committee. And then 2008 hit, and we're meeting almost every day. Just bond prices were just nosediving, just crazy in 2008. We didn't need to sell the bond. We just had to put it in our mutual funds. You know, we had to figure out what price to use in the mutual fund. And I will talk about some of that because it was a pretty scary year. So what are illiquid assets? Real estate, corporate bonds can be quite illiquid. Most corporate bonds are over the counter type of trades, and they usually trade in really big lots, like $500 million investment blocks. They're especially illiquid in the credit crisis like 2008. That's why in 2008, I was telling them sell the swap and buy corporates. And that's one of their feedback to me, but it's a dead market. And say, yes, a dead market for sellers. There's nothing better than to show up with $500 million when you're in a buyer's market. It's kind of a nice time to be having cash to throw around. But we have a credit crisis. We had a credit crisis in 2008. Didn't quite see the credit crisis in 2020 because of the government massive loans coming out. But credit crisis can show up out of nowhere and cause pretty significant disruptions. Liquid assets, stocks are very liquid. I've never been in an entity that was so large that us selling Apple stock was going to cause Apple stock to fall. It's just, stocks are very, very liquid securities. I don't even know how to time my trades on my broker. I don't think if I hit trade and went to history, I could do that fast enough that the trade hasn't already happened. I mean, it's just like a millionth of a second. I don't know what someone's watching me and it's like, as soon as I hit that button, they're already got it. It's just amazing because the other side's not a human being. The other side's a computer. I mean, it's just ridiculously liquid securities. Treasuries are very liquid, supposedly. Some of y'all heard my story from 2008. I maybe even told you, did I tell you the T-bill story yet? I can't remember. Did I already tell you that? That was probably my investment class, though, right? Okay, but yeah, so in 2008, T-bills disappeared. You couldn't buy T-bills because no one was selling them. They were clinging on to them for dear life. So that was unheard of. I can still see Donna's face when I told her, yeah, just buy some T-bills. And she's like, I can't buy T-bills. Like, I thought it was, Candid Camera or something. It didn't make sense to me. Other government type securities, most asset-backed securities are pretty liquid securities, mortgage-backed securities. Exchange traded derivatives like options and futures can be very liquid. You have to be real careful in a year like 2008. What happened in 2008 is you had futures and you had the underlying. The underlying was very illiquid, but the futures were very liquid. What happened in 2008 is because the futures were so liquid, that's what people were trading. So you saw futures markets actually get completely out of sync with the underlying because the underlying was illiquid, couldn't be traded. They traded the futures. So we saw some strange stuff happen in 2008 that was, no textbook would talk about. It was just a very, very crazy year. So illiquid assets prices fall so much on these type of prices that you have to take notice, even though you don't need the cash. Yeah, I'm not joking with 80% drops in price on bonds. We thought were perfectly legitimate bonds that were going to pay off on time, no issues. 80% drops, just an extreme lack of liquidity. Now, why did it drop so much? Well, people weren't selling these bonds. But then you had one person somewhere that just needed to sell a little bit, a small sliver. And so they sold some and they took what they could get. Well, suddenly we have a market price. So the last 2 months we didn't have a market price because nobody was selling. And one person sells a small chunk. So we have it on our books at 82 and they sell it for 30. And what do you do? Well, GAAP accounting says, hey, if you have a market price, you got to use it. Well, we don't believe that price. That's some desperate seller just trying to sell the thing, get it off their books because it needs some cash. That's why our committees got together. What do? So we have the model price. The model price says this is what it's really worth, but we actually have a market price now. And boy, it was painful. And we had to meet, at 4 o'clock because they had to strike the NAV by 5 o'clock. We had to make a decision really fast. They had to put it in there. But not only that, if let's say you got bond A at 87 and bond A sells a small amount at 40. So bond A, you got it on 7 at 87. That's the model price. All right, that's what investment bankers give you, that model price. This is what we think it's worth. So that's the model price. And if someone sells something, so now you got 40. So now you got to decide, do I write that 87 down to 40 because we have that price? Do we have some legitimate reason for ignoring that 40? But what else happens? We got bonds B, C, D, etc. that are related to A. Now what do? Oh, this is the bond. Bond A is in this industry with this credit rating. Well, we've got 7 other bonds just like that. Do we write them all down another 47% or not? I was like really happy I was a equity manager and not a bond manager. It was really rough. I remember at the end of the year, I ran the Cornerstone Fund, which was 70% stocks, and it had a miserable year. And so the board's on my case, Ron, what did you do? And I go, the stocks are down, but our stocks actually did really well relative to everybody else. I said, well, how can your fund be doing so horribly? Well, remember, there's 30% in bonds. And he got crushed. He did great in 2009. He came right back. He probably had his best year ever in 2009. But he was down more than my stocks were down. And the board was all over my case. I was like, I'm sorry, it's not my fault. Not that I was trying to get out of the blame, but yeah, his bonds were just nosediving. And it's this kind of thing where when you have an illiquid market, little bitty trades can cause total mayhem. And that was 2008. I don't know when we'll see another one. We had something like that similar in 1994, probably 98 a little bit, but not nearly to 2008. 2020, we kind of skipped through that a little bit. And we've actually seen corporate spreads get to almost all-time lows in 2021. So even after 2020, it was like the bond market says, no one's in trouble, everybody's fine, there's no risk out there. So, and the bigger issue for the Feds is distinguishing between a liquidity crisis and a solvency crisis. So Lehman Brothers is a good example. Did Lehman, was it a perfectly reasonable firm? They just couldn't get cash. They couldn't borrow money, but otherwise perfectly solvent, perfectly fine firm. Or was Lehman actually insolvent? Their assets were really worth a lot less than their net worth or their liabilities. And the Fed's got to make that decision. If they're really insolvent and the Fed steps in and gives them cash, you're just going to make the disaster much worse. But if they're not really insolvent, they're just illiquid, the Fed needs to step in so you don't have this domino effect. And that's a tough one to figure out. There have been some complaints about some of these Japanese banks that have been continuously supported by the Japanese government that some people say, yeah, they're really insolvent. Just let them go, let them go under. That'd be better. But you wouldn't wait. Paulson has gotten credit for doing a pretty good job in 2008 of managing this. But that's the kind of thing he's thinking about. Do I bail out Lehman? Do I bail out AIG? Do I bail out Washington Mutual? Some of them they did, some of them they didn't. You got to remember Paulson's a Goldman Sachs person. If he bails out Lehman, everyone's going to say you're bailing out Lehman to save Goldman. So that doesn't look good. They didn't bail out Washington Mutual, but they did bail out AIG, or at least gave them a loan. So, you know, not an easy job at all. I don't know how much they have to pay me to take a job like that. I wouldn't do it very well if they did pay me, but tough decisions they had to make. And if you think about it, you know, I mentioned this with Lehman, very complicated balance sheet. So it's not like you walk in 30 minutes, you know what's going on. Every single bond they had was a fairly intense assessment analysis. So it's not an easy entity to really figure out. So how do you measure this? This is what I'm curious what you're going to do in your paper. How do your banks measure liquidity risk? And it is, I think it's unmeasurable, but I'm curious, are your banks telling you anything that's a measurement? So with interest rate risk, you got duration, convexity. With price risk, you can look at the standard deviation, you can look at betas, you can run simulations, but liquidity risk, how do you actually measure liquidity risk? Have y'all done a search on the word concentration? So you might try that in the liquidity section. What does concentration mean? Make sure you don't have too much invested in one place, whether it's one company, one industry, one particular commodity price. Check your concentration. So do your banks do that? How much do we have exposed to oil prices? How much do we have exposed to China? How much do we have exposed? You know, they do those kind of things. How much do we have exposed to any one entity? That can be important for credit risk and for liquidity risk. Stress tests are important. That may be the main thing your banks are doing on liquidity. Have y'all seen that stress testing? So that can certainly work. So stress tests, extreme scenarios, again, looking for unexpected correlations between entities and assets and just trying to think as much as you can. Here's my solution though. Where will the next liquidity crisis come from? It's going to be whatever the last most crowded trade was. So where were people rushing in as desperate to buy something a few years ago? That's going to be the next liquidity crisis because they're going to be rushing out on the other side. So today's most crowded trade is going to be tomorrow's liquidity crisis. But this stuff, I'll be curious to see how y'all handle this one. It's not an easy thing to measure. How do you mitigate it? Same thing. How do you mitigate it? Concentration limits. Assess where your exposure is, not just one entity, but one entity, one industry, one sector, one asset type, one macro factor. You know, subprime mortgages in 08, we talked a lot about that. What is our exposure to subprime? Trying to figure that out. And you don't always know because things are interconnected that you don't really realize. Sometimes you ask the people you invested with what their liquidity plan is to see if you can, you know, tap into that if you needed. You can always hold cash reserves. Here's what USAA did is every quarter. So this, our risk committee met quarterly and the CEO showed up. And one of the things we always went through was our list of liquidity. Where can we get cash if we're desperate? And it depended on the entity. So a good example was, let's take the PNC. They're exposed to catastrophes. So that could be $3 billion. Major hurricane, major earthquake. That's a lot of money, right? $3 billion for a $20 billion company. That's a lot of money to have to spend all at one time. Now they have a $20 billion bond portfolio. They could sell the bonds. That's possible. The nice thing about catastrophes, if there is a nice thing, is the bigger the catastrophe, the longer it's going to take to pay it out, to rebuild stuff. So it's not like you have to pay $3 billion next week. It's probably going to be over 6 to 9 months. So our question was, well, what if we don't want to sell the bonds? Because the concern there, if you have that massive of a catastrophe, all the PNC companies are going to be selling bonds. So you're going to have this pretty big, intense sell going on in bonds. That could cause the bond market to crater, and we don't want to sell in that. Well, could we sell something, get money out of the life insurance company? Maybe they could send the major dividend up. So the big thing we did was securities lending. So we had a $20 billion portfolio that we didn't want to sell. So you could loan out against those securities, and that was very, very liquid. And so that was a big chunk. We could probably get $14 billion, $15 billion almost overnight out of that. I mean, maybe not overnight, but in a few days, we could get a lot of money out of that. We still own the securities. There are securities. We get cash against them. That's a pretty fast way to get cash. And then we tested it. So USAA went out. I remember one day we did this. We went out and borrowed $300 million that we didn't need. Why would you borrow $300 million that you didn't need? You just want to see if the facility was working. We didn't tell them we were going to do this. So what the CEO said is, I want you to do securities lending, $300 million, and don't tell them you're doing it, and just do it. That's pretty smart to me. I say that's going to cost you a lot of money. So what if they charge 4%? Well, you might say, well, that's going to cost me $12 million. But no, it's not going to cost me $12 million. What's it going to cost me? Cost me $33,000 because it's only for one day. Right? So it doesn't cost me. Is it worth it to USA to spend $33,000 to make sure they can get $300 million in a nanosecond when they got a $3 billion exposure? I would say that's probably a pretty good use of funds. So securities lending was a big one for us. But every committee meeting, we did that every quarter, went through every single list. If the bank had a major issue, the bank could sell hundreds of millions of dollars of certificates of deposits to the property and casualty company. Now you can't just do that. So banks sell CDs to PNC. Well, you can't just do that. So you have to go get regulatory approval. So you don't just assume one entity can send hundreds of millions of dollars to a related entity when both are heavily regulated entities. One's federally regulated, one is state regulated. So we went to the state in advance and said, we need permission to buy CDs from our bank and got approval in advance, got it all documented. So that may be the biggest part of liquidity is you don't just assume you're going to do something, you actually make sure you can do it and test it and go through all the paperwork and everything you need so that you can make sure. So I thought it was very good CEO, the way he thought about things is don't tell me you can do it, prove it to me. Go and actually do it. $300 million is a lot of money. Go do it. You're telling me you can do it, so prove it to me. Yeah, $33,000. That's chump change. I can handle that with a $20 billion company. So I'm curious what your banks are saying and how they're gonna handle it. There is a pretty famous phrase, isn't there, out there? Run on the bank. Where did that come from? Probably related to banks, wasn't it? Why do we have runs on banks? It's a liquidity crisis. People start worrying about the bank. When they start worrying about the bank, they start taking their money out. Too many people do that. The bank says you can't take your money out. That hits the news. Then what happens? Now there's a line of 100 people outside your bank and none of them can get their money out. I mean, it's how do banks handle these type of liquidity crises? How do they get cash out? So obviously the Federal Reserve, did they mention the Fed desk in their bank solution? How do they get their hands on cash really quickly if they need it? These are big issues. I think most finance students look at this and go, well, obviously JP Morgan has this figured out, but don't assume that. You might be surprised how stressed out that people at JP Morgan are when these things come up, because these are complicated banks and they don't really know every single scenario. They try to think through every scenario. So this is stuff. So I'll be curious to see what you say. It might be the shortest part of your paper because it's just such a hard risk to handle. I've noticed every one of your banks has a section called liquidity risk, so it's in there, and I'm kind of curious what they're actually saying. Anybody want to share what you remember? Remember anything on what your bank said? So maybe my question is, are they actually saying anything? Or do they just, can you tell when a bank is just saying stuff because they need to say something and there's really no substance behind it? So, I'm glad at USA there was substance. We actually took it seriously. All right. So price risk, this is the big one. This is one we talked the most about. You've done this before in previous classes. So we'll start simple, and then for the second exam, we'll do more advanced problems. We'll start pretty simple the first exam. So what is price risk? I don't know, what are your banks calling it? Are they calling it price risk or market risk? Market's probably more common. So market risk, and that includes liquidity and interest rate risk. So market risk. So you might say market risk is the risk that asset prices fall, but expanded to asset prices falling or liability values rising. So you got to think both sides of the balance sheet here. So interest rate risk is a special case of price risk. How do we measure it? Well, all those things, we talked about this before. Standard deviation is pretty common. Beta is pretty common, although I doubt your banks use beta. I'm pretty confidently sure all of your banks are using value at risk. So if you don't think your bank's using value at risk, let me know and I'll find it. It's pretty universal for these big banks. I don't know if Frost Banks uses value at risk. USAA, we use value at risk quite extensively. Stress tests is probably in there quite a bit. I can't imagine any of your banks don't do stress tests, especially given that the federal government does stress tests, requires them on the banks. So the banks are doing them for the federal government. I doubt your banks, I'm sure they're doing this, at least duration they're calculating, but I doubt they're reporting it. So if you do a search on the words duration and convexity, you may not find it in the annual report. They just tend not to provide that information, but it's in there. One thing to be careful of with duration and convexity is that it's really tricky to calculate it for our banks. So I can tell you with USAA, we did it with and without core deposits. And the reason we calculated duration liabilities with and without core deposits are your checking accounts and your savings accounts. Doesn't count CDs are easy. It's easy to calculate the duration of a CD. That's maybe the easiest one there is. But checking accounts and especially checking accounts, but checking accounts and savings accounts, those are called core deposits. The reason we did it with and without them is there's a lot of uncertainty how to calculate duration for a checking account. How sensitive are checking accounts to levels of interest rates? And there's some thought that there's no sensitivity. The duration 0. Savings account, I don't know, what are your savings accounts paying you right now? You can notice it. You get your savings. Oh, I made 12 cents last month. Oh, great. I think I'm up to like $3 now on my monthly interest. These tend to be transactional accounts. They tend to be, checking account. You're not going to say, wow, I can get 0.23% over here. I'm only getting 0.2% here, because the checking account is really hard to shut down because you got all these, all these things tied to it, your credit card payment, your CPS. But the problem we had was when we did it with and without core deposits, we didn't get slightly different answers. We got the opposite answers. The duration flipped from positive to negative. So very, very frustrating. That may be one reason why your banks don't report this, is those core deposits are real pain. So I think with us, it made more sense just to do it without the core deposits because there's so much uncertainty. And those were pretty reliable accounts. They're great accounts. I mean, banks love savings accounts because they're paying almost no interest at all. And their customers get FDI insurance, which is wonderful, which is why they accept the ridiculously low rates. So it's a really cheap way for banks to borrow. Checking accounts, not so much because they're transactional, so banks have a lot of expenses there. But yeah, it's tough. So your bank's probably not reporting that to you, but I did see some of your banks did do what we did on the stress test. Up 300 basis points, down 300 basis points. I saw that in a few of the banks. So that's a stress test that's pretty common. So we're going to focus on value at risk. That's going to be our main one that we're going to do. There's 3 ways to calculate value at risk. We're going to do parametric in here. That's the simplest. And we're going to do historical on your second project. I've never had the guts to try stochastic. My fear is, I mean, you can build one using random numbers in Excel. My fear is if I did something in Excel, it's always nerve-wracking to me to give y'all a model that's got some complexities, and then you open it on your Mac or some other PC. I've got a model one class is using, and it doesn't work. You know, Capital IQ doesn't work on a Mac, and it's just frustrating. So I'm kind of worried about it. One of these days, maybe we'll try it. But you can do some kind of decent stochastic. So parametric is you just use the normal curve, mean, and standard deviations. Very straightforward. Historical is you just take your business and run it against a certain number of days historically, last 200 days, whatever. That's something your banks probably do. So what you want to do is try to figure out what historical period are they using. Is it the past 200 days, the past 500 days? They'll probably tell you that using historical VAR. Many of your banks might use stochastic VAR. It's more common on the life insurance side. In fact, life insurance companies are really good at stochastic analysis. That's the simulation. You've got a model, pretty sophisticated, well linked. All the pieces are linked. But I'm not sure banks do stochastic analysis as much as life insurance companies do. But both life and property casualty companies do a lot of stochastic analysis, mainly because the risks are so complicated. You really, historical VAR on earthquake risk, there just haven't been enough earthquakes. You'd have to go back like 5,000 years to try to get data that you need. It's just, they don't happen very frequently. So using historical VAR doesn't make sense. Parametric, we use parametric at UTSA just for the investment side, and then use stochastic for everything else. So you can mix and match them together. So see if you can figure it out for your banks. More than likely, they're doing historical and stochastic, but whether they tell you that or not. But we're going to use parametric primarily in this class. And so it's not a stress test. So keep the distinction. The value at risk, you are applying some statistics to this. So you do have something statistically that you can say. Whether the statistics are reliable or not is another question. With stress tests, there's zero statistics. A lot of people on the stress test, they say, let's run our worst case scenario. Our worst case scenario, that was 2008. Well, the worst case scenario in 2007, 2008 wasn't the worst case scenario because it hadn't happened yet. So if you go back historically and try to find the worst scenario, that was just the worst at that time, but the next one's going to be even worse. So you don't know the probability of 2008 happening again. So if you run 2008 through your business and you get the numbers, you go, okay, what does this mean? If we don't think it's ever going to happen again, then it's just a gee whiz number. If we think it'd be worse next time, then it's not even risky enough. So I'm not a big fan of stress tests. To me, the key of a stress test is to understand your business. If oil prices do this, what does that mean for us? If the VIX, the volatility index, does this, what does that mean for us? And I like it just to understand the business and to go to extremes, major extremes on that to understand the business. All right, so here's the formula. The basic formula we'll use on exam 1, mean minus number of standard deviations times the standard deviation. You probably use that several times in at least one of your classes. So the mean is the average. Most of your banks do a daily VAR, so the mean is essentially 0. On a daily basis, your best guess for the S&P 500 tomorrow is 0% return. And it's, I think over its long term, it's average 3 basis points a day, 0.0003. So 0 is your best guess on a daily basis. On an annual basis, yeah, it's a little different. The standard deviation, where did you get that? Again, we're talking daily standard deviation. On the S&P, that's 1%, but on your bank, it could be a different number. So the standard deviation, usually the standard deviation is based on history. That makes sense, but the standard deviation is very volatile. So the standard deviation itself has a high standard deviation. For the S&P 500, it can be as low as 9% over a pretty long period of time. It can be as high as 25% over a long period of time. It's a pretty wide range. So what are you going to actually use there? But on a daily basis, you're probably using something in the 0.5 to 1% range because it's daily. And then the number of standard deviations ties to your risk tolerance, your probability. So you remember 2.33? 2.33 is a 1% event. Does that sound familiar? Did y'all do something like this in your stats class? You remember going through the tails and looking at the tails? So a lot of times you did the two tail tests, you know, you like the 66% the time between here and here. We don't really do that in finance. We're all really focused just on the downside. So it's a one tail test. So I like to write, when I write VAR, I like to put the risk tolerance in the title. VAR at 1% equals the mean minus 2.33 times whatever standard deviation is, right? So you can see it. These things are out there. So y'all remember that stuff, right? So you have a distribution right in the middle is the mean. 68% of the time is plus or minus one standard deviation of the mean. So we're not doing the plus or minus, we're just going down to the bottom. So if you go to 2.33 standard deviations, it would be 1% to the left and 99% to the right. All right, that's what that 2.33 means. What's 1.64? You may remember 1.64. What probability is that? It's a round number, so that might help. 5%, yeah, 1.64. So how do you do this? So it's pretty easy to do in Excel. You probably have this in a table somewhere, but the way you do is you start at 0. And then across the top, you add 0.1, and down the bottom, you add 0.01, and you go out however far you want to go out. That's not how you do it. Oh, how do I do it? Oh, I just forgot how to do it. So this goes to there, starting 0. Maybe it's plus. Oh man, what did I do? Plus 0.1. I can't remember what I did. I just completely forgot. Well, anyway, and then you do equal norms dist, and you add the two zeros together. Yeah, I think this is plus 0.01. And then this is plus 1. I think that's the way I did it. All right, that makes more sense. All right. So what percentage of a normal curve is to the right of 0 standard deviations from the mean? The answer there is 50%. All right, so 50%. And then as we move across, that probability will change. Did the math right? Oh, that's, yeah, sorry, I hit the wrong one. Here we go. So 0.09 standard deviations would be 53% to the right, 46% to the left. And if we copy that all the way down, that's where you find the 1.64 right there. Y'all see that? So 1.64, that's why I say it's a 5%. Y'all see why I say that's a 5% event? Let me put some titles in here. So 2.33. That's that 1%. So this table is giving you the one side. So Goldman Sachs says they're 5% risk tolerance, or not, they say they're 95% risk tolerance. In insurance world, we'll say it's 5% because we're focused on the downside. All right. So that's how you do it. This is pretty straightforward using normal curves. So let's say someone has a risk tolerance. Let's do USAA, 0.2%. So what table value are we looking for? So what in these numbers are we looking for to find a 0.2%? I don't see 0.2% anywhere. We're going to look for what? We're looking for 0.998. Everybody agree with that? So we find 0.998. There it is right there. So that would be a, whatever that is, 2.88. And you're seeing right away a huge issue with the normal table. Here we have a 1% event, which is 2.33. A 0.2% event is 2.88. There's not a big difference in those. As you move down the table, you're not going from 2.33 to 12, you're from 2.33 to 2.8. And that's an 80% drop in your probabilities. So, you know, that's pretty material. What's the chances? Well, let's do one on what if you had a 3% risk tolerance? What's your table value here? Someone yelled out just so I know you're awake. 0.97. So 0.97 right there. I don't know, in your stats class, I had a stats professor. We had to interpolate between these two and go out like 10 decimal places. Just at the time, I was like, yeah, we better do that. And now I realize we're like this to start with. Where did the 3%? Why wasn't it 3.0126% probability in our risk tolerance? So we start like this, and then we go out 10 decimal places. It's like, why? So there's no reason to interpolate. I don't care if you use this one or this one. Pick one of them. I usually round up anyway. So I actually use 1.65 because, you know, we know it's already got some fluff in it to begin with. At UTSA, I used to tease the accountants. They would call for a number that was like this, and I would go out 10 decimal places. And I would say, oh yeah, I'm just joking. Oh yeah, that was funny. But I didn't hear the last three numbers. I was like, I'm sorry, I shouldn't pick on accountants. That's really mean. But I want them to see, yeah, I mean, we're talking really broad. We should be rounding everything to millions, and there's no reason to have that kind of precision. What's the probability of a 6 sigma event? So +1 minus 6 sigma event. There it is. And 365 times a million. Is that right? It's 1,000, a million. So in a million years, you wouldn't see one. In a billion years, you would see one day. So it's a billion year, and that's not this isn't annual. I mean, I'm doing it, you know, times. Oh, I forgot to do the 365, didn't I? So yeah, sorry. I thought I hit the 365. So in a million years, I guess there would be almost one day. So a 6 sigma event is practically impossible. Have you ever seen 6 sigma events in the US stock market? Yeah, I'll show you several of them. When you get down to an 8 sigma event, Bill Gates just gives up, says it can't happen. Have we had 8 sigma events? Yeah, we had several of them in 2020, all in the same week. So obviously the S&P 500 is not perfectly normally distributed. It's got a little more noise in the tail. All right, so that's what we mean by the risk tolerance. So I'll give you the risk tolerance usually, and you'll just plug in the mean. The mean is usually, for a lot of problems I give you, is the mean is 0, but not always. We'll work some different problems, but it's pretty easy. It's just a matter of plugging in numbers. I'll give you the table like this, and when you get the table like this, you just got to go find the right table value. And the table value is, if I say 2%, you got to take 1 minus 2% and find that 0.98. So you just have to know to do that, but it's a fairly simple, straightforward problem. Now, when you do a mean, do a buy at value at risk, the type of problems we're doing will almost always give you a negative number. Because we're talking about a 1% event with the stock market. 1% of the time, you're expecting to lose money, and quite a bit of money. But we don't usually express bars as the negative numbers. We express them as positive numbers. So at USAA, their value at risk was say $3 billion. We don't say, hey, our value at risk is negative $3 billion. We say it's $3 billion. That's how much we expect to lose 0.2% of the time. So you know it's a loss, so you just say it's a loss. So express it, just write it as a positive number. Their value at risk is 35, and that's what the banks do too. If you look at the banks table on VAR, you know, it's 37 million. It's not negative 37 million. You just know that it's a loss. Oh, I didn't mean to put the word "come" back there. You can take that out of your notes. All right, so that's measurement. We'll practice with this quite a bit to get some exposure to that. Is this coming back to you, although hopefully you've seen this? We do this. I did this at USAA for some simple stuff. Sometimes this is good enough. You just need a ballpark number. So the way we did it at USAA, they ran a really complicated stochastic model for hurricanes and earthquakes. And then the assumption was if we had an earthquake or hurricane that large, the stock market would probably have a pretty bad year. So we said, let's add a 1 in 10 year stock market. And I just used this math. Was it good enough? You can see, you know, stock market's a little more risky, but that was good enough to add. They just needed to add an extra number in there. It makes you recovering for a market risk of some kind. So I gave them this real straightforward, pretty simple kind of stuff. How do you mitigate it? We're going to talk a lot about this. So be ready. This is a major question on the second exam. So the main mitigation, you see this in your banks, is I don't know what they call it. Correlation, diversification. Boy, what are they calling it? I've seen some of your banks have some other terms for this. Someone will probably even say, make sure you don't put all your eggs in one basket. So anyway, but correlation is the #1 risk tool in finance. This is an area I don't think finance works very well. We'll talk about this. And it's not just but I have some pretty strong support behind me. And then I have some enemies. So I'll show you the opposing side this time. His name is I can never remember his name, sorry. Burton Malkiel. There's a Russian composer whose name is very similar, and that's the first thing that always comes to mind. But Burton Malkiel. We're gonna watch a video by him. There he is. That's several years ago, so I think he's still alive. But there's a video where he absolutely disagrees with what I'm going to tell you. All right, so I'll let you hear his side, and then because he's not here, I get to then badmouth him after y'all watch this video. At least where I disagree with him, because I think he makes. The fortunate thing I have is he said that 12 years ago, so I can now go back and say, well, what if he'd done what he told you to do? So that gives me wonderful hindsight. So we'll watch this video. I've never read what Random Walk Down Wall Street. I have read Dr. Lowe's Adaptive Markets. You should read it. He has an entire chapter where he disproves Random Walk Down Wall Street. The markets do not have a random walk. They actually violate the statistics of random walk. So, you know, I have read his. So I guess since I've read Dr. Lowe, I don't have a reason to read Random Walk anymore. But all right, so we're going to talk about correlation. Does diversification actually work? We're going to spend quite a bit of time on that. On the second exam, we're going to use this formula you absolutely should know by heart. Very, very famous formula. Hopefully y'all remember this. Y'all have seen this before, haven't you? Weight squared times standard deviation squared plus rate squared times standard deviation squared times 2 times weight times standard deviation times correlation takes square root. Y'all remember that? If not, you're going to be doing it on the second exam. A lot of number crunching on the second exam. A very, very famous formula. A massive part of finance is that formula right there. And I'm going to tell you, I don't think it works. All right. So we're going to do it. We're going to practice with it, and I'm going to throw it out. So I'm going to leave you hanging, but I'll show you some alternatives to that. All right, we'll start here. I can tell you all are already out.